Hello everyone, welcome to another lovely episode from JFX House. And I'm your host JFX. And on today's video, we're talking about smart money concepts. Okay, so this is something we've not done in a little while, with the series on Elliott Wave and the series on Wyckoff dropping every single day. So today's episode, we're talking about smart money concept. And we have a little hype going on within the community where we have different individuals dropping their insights and ideas of what they think about liquidity and inducement. And with all those great ideas, I just decided to drop this video to give my insight and my own study of how this entire system works. Okay, now when it comes to smart money concept and the ideology of inducement, I want us to go back to the fundamental meaning of what the word inducement mean. Okay, so you need to understand that before the word inducement was being used in the aspect of technical analysis, it's a word that has its own meaning. And this meaning gives a lot of insight to why it's being used today in terms of liquidity. Okay, so as you can see over here, searching for inducement, you can see it's a motive that is considered to lead someone to an action or to do something. So when we talk about liquidity, we know we're talking about the algorithm basically attracting retail traders and other traders into trap moves or making movements they're not quite sure about. Okay, so inducement is introduced as a word that breaks down the concept of liquidity to an even deeper perspective. So liquidity is a form of inducement, and inducement is a type of liquidity. Understand what I'm trying to say? Liquidity is a form of inducement. So when we say liquidity, we say the algorithm is creating programs to attract what? Traders. So an inducement is an action, as you can see, that makes someone to do something or persuade someone to do something. So you're being induced. So that is liquidity. And liquidity, in terms of technical analysis, has a type that we call inducement. Okay, so liquidity is what we refer to in technical analysis as inducement because it's when the algorithm persuades you to take an action, based on what you think. So we have different types of liquidity like support and resistance liquidity, trend line liquidity, channel liquidity, inducement liquidity. So in terms of technical analysis, we have a model which we identify as an inducement. So this is a type of liquidity. Okay, inducement is a type of liquidity, but liquidity in general is a form of inducement that the algorithm used to attract traders. So this is a little conflict we have within the terms and understanding. So what I'm going to be doing in this video is introduce you to the model in technical analysis, what we call an inducement. Okay, the model within liquidity that we refer to as an inducement. So from this model, you can craft out any pattern you find yourself seeing in the market because patterns are inevitable with the fact that the market moves in charts. So every day a new pattern is formed, and these are formed of real life data. So new patterns can be formed. So liquidity is a model, not a pattern. Multiple patterns can be formed. So I'm going to be giving a breakdown between two of the most popular patterns, or you can say two of the most popular models I use to support my liquidity or I use to mark out my own inducement. Okay, so this is the type 1 model. And on this type 1, you can see there's a little difference between that of the type 1 and the type 2, which is something that traders don't really consider when it comes to identifying inducement. Now, what's the difference? On the type 1, we see the liquidity was formed after the break of structure that had the demand level. Okay, so we had a clean structure to the upside that broke the trend, and then we had a retracement into that range. While this retracement was happening, price created the inducement and cleared it out and then moved in the direction. This is my type 1 kind of an inducement. And then the second type 2 diagram, we have price creating the inducement before returning back into the range to clear out this liquidity in an even more faster way. Okay, so which of this model is more preferred? As you can see, both of them are respecting market structure. So market structure has to be considered. But in terms of real life markets, which of these models do I find more common? Now, I'm speaking from experience. You might have more experience than I am. You might have been using liquidity for more than 2, 3, 4, 5 years, who knows? And you might find this knowledge not quite direct to your level of liquidity or to your model, which you use in spotting liquidity. That's all fine because we're all analyzing different markets and we all have different perspectives. So, but what I want you to understand here is that all I'm giving you is out of experience and what I have identified over the years on the chart. Okay, so you can use this to also program your model. If you truly know what you're doing, that should not be hard for you. And then you can use it to identify and see how much it works better for you. Okay, so back to what we have on the screen. On the type 1 kind of inducement here, which is also a liquidity, because as you can see, this move will persuade a lot of traders to sell from this point. Let me take this out. Will persuade a lot of traders to sell from this point, right? Thinking this is a bearish structure, coming with the most recent move, right? So they'll be thinking something like this is about to happen. So that makes this a liquidity high, okay? And then makes this a liquidity low. And why is this a liquidity low? Because at the same time, this low was created few pips away from a major demand level, which is in line with the market structure. So this is a higher high, and this is a lower high, and then we have a higher high. So this is a bullish structure. And following the structure, we understand that this also can actually be a lower high being formed, and price is moving in the upside, right? So traders who are not familiar with the concept of liquidity or not familiar with the concept of supply and demand zone, who could not be able to identify this as a demand zone and this as an inducement for them to buy from this low. Okay, remember I told you the low is liquidity, the high is liquidity. So I'm explaining why the low is liquidity for you now. So traders who do not have this understanding that this low is an inducement that is actually inducing them to buy, thinking price is going bullish from here, would end up buying the market. These people, we call them the quick reactors. So these guys who buy impulsively, they just rush into the market. They have no patience. So they all start buying from this area. And then on the chart, most of the time, this area is seen as a support or resistance level. So you find them buying from this point, and the price does a quick swipe, which is where the concept of stop hunt comes into the picture. So if you look at this carefully again, you would understand that if we were to identify a stop hunt, this would be a stop hunt. Okay. And then if we were to identify the next possible move within this, we would then expect something like this. And then like this, having this as a stop hunt, and then this as our demand zone. So this will be a continuation of this bullish trend, right? So with that being said, you understand why this low is considered as liquidity and this high is considered as liquidity as well. So the concept of liquidity and inducement goes in hand, okay? On the aspect of being bullish, traders are induced to buy early from this point, which makes this an inducement. Traders are also induced to sell from this point, those who pay attention to market structure without formal understanding of multiple time frame. They end up getting trapped at this point. So this is also an inducement for them for the early sellers to sell, or those guys who think price is still bearish to sell. So this is an inducement, this is an inducement, and this is a concept of liquidity. I just want that to sink in so we can understand further what we mean by inducement and what we mean by liquidity. Okay, so when price is creating this, is engineering liquidity. As you can see, liquidity was not created before the break of structure, but instead created after the break of structure. Okay, so obviously this wouldn't have happened if we were still here, right? So this break of structure has not happened yet. So this would be the formal break of structure. So when price is doing something like this is called engineering liquidity. So you find price creating multiple highs and multiple lows around this area before clearing them out real fast. This is where Wyckoff happens. Okay, the manipulation of Wyckoff happens around this area, and then there's a spring into demand zone before price moves to the direction which it tended to. So this is basically the concept of liquidity identifying when it comes to the model one, my type one kind of liquidity, I try to look for the liquidity that is being created recently below my area of interest, not a liquidity that has been created in the previous range, because that is what I consider as a type two. And then I will tell you the difference and why I have this breakdown for both of them and which I consider to be high probable to the other. Both works and both can fail. But at the same time, there's one which should be considered, the high probability kind of setup to trade. Okay, so that is what we have for type one. And then moving on to type two for the breakdown. Looking at this, we have liquidity being created before the break of structure. Now, how is this possible? Because if this happens, isn't this considered as the lower high? For curiosity, this would be the higher high, lower high, and the higher high. So won't this be considered as the break of structure? Now, these concepts, I understood this concept better when I started looking into the concept of premium and discount when it comes to the range. Okay, so if we're looking at this range at this moment, we would, yes, consider this to be the high after the break of structure, right? But for us to consider this to be the low of this structure, the price has to basically retrace at least to the 50% of this previous range or below the 50% into a more discount price. Then that would be that this range has been mitigated and price is currently looking to move forward into the bullish arena. So, but what we have instead is price giving a minor retracement, retaining the premium level, the discount level, and just mitigating the premium level of this range. Okay, so we see something like this. I mark them out as liquidity because why? I believe the price would still retrace into the discount of this range. Even if this is not going to hold, it's going to respect the discount of this range to give a reaction, having this within premium. So price would basically target to clear out these highs first, even if it's completely bearish, before it moves into this direction, because a lot of traders have stacked up around this area. And if you look at this carefully, you'll find out that that is also seen as a support, a resistance level being broken and becoming a support. So this is where the concept of support and resistance liquidity comes in. I don't know if you guys are following up with what I'm saying. So on this aspect, this is also considered as liquidity because price is going to be clearing out this low. A lot of traders will be hoping for price to give a reaction to this level. Okay. So when price does something like this and then clears out this low, we're going to be identifying this as the lower high and expecting price to break to continue the structure. So this is a more complex understanding of liquidity and inducement compared to this. Okay, so obviously simplicity is the best. So I always consider this over this. Okay, but at the same time, if I see liquidity being built before a formal break of structure, then I expect a quick move from this. Okay, so when you see something quick happening, you know you're going to get in and out as fast as possible. So it's kind of like more clean when you say a complex inducement, and then you find yourself getting a good entry and price reacting quick from your area of interest. And then when you have this, because in situations like this low can also be targeted as a level of stop hunt, because I told you guys this is where the Wyckoff accumulation and manipulation stuff happens. So this spring sometimes goes below this low, okay, and then closes back above this. So when things like this happen, I still consider them to be valid. The structure is not yet broken because it didn't close below this low. So on setups like this, you find those kind of things very common than when you have setups like this, because there's no intention within this move other than to clear out the liquidity. You see? But on this hand, the intentions is to create the liquidity, which is to engineer the liquidity first before manipulating traders out. So when you find complex situations like news and stuff like that, you want to look for the liquidity because they're not going to be creating the liquidity when the effect is already taking place. They're instead going to be clearing out the liquidity, which has already been engineered into the system. Okay. But when you have a low momentum trading system and let's say the pair, there's no fundamental and it's just obeying structure, then you find yourself in a system where liquidity is very common and price could just, do whatever he wants and engineer liquidity and then, takes it out all over again. So this is more preferable when it comes to better results. Why this is more preferable when it comes to understanding structure and observing price action, because as you can see, it has a much cleaner structure compared to this. Okay, this is more complex to understand and needs more attention when it comes to identifying this. And the factors involved in this, as you can see, we mentioned premium and discount. We didn't have to do that within this as well, but we had to within this because on this level, price creates the liquidity around discount level, to induce traders even more. So you see this retracement into discount before price moves in that direction. So this is not the only models you have. We have multiple models also, which are created of similar patterns like this. And these are all based on ideas of market structure. And as long as you understand market structure, it's going to be easier for you to understand these models. But for me, these are the two systems I use for identifying liquidity, and this is how I identify them. So I'm going to go into the chart now. So I'll show you guys a little insight on how I do this on chart and the difference between these two concepts, which I just explained for you guys. Okay, so on the chart now, this is a low momentum market. Okay, let's look at this and see if we can find the type one, the reactions that price creates the liquidity after a break of structure. Okay, so if we are to identify the structure of this, we would have something like this. All right. Okay. So looking at this now, as you can see, there was liquidity within this range, right? But when price retraced back up, what happened? Price created new forms of liquidity, which are these relative equal highs over here. And then that was also created to engineer traders to want to sell from this point, knowing that we had a pending supply area around this zone. Okay, so liquidity was engineered after the break of structure that happened here. Okay, so they still engineered liquidity before, the stop hunt came in, cleared out everybody, and then price moved in the direction. So this is more like a type two, where the liquidity is created, a type one, sorry, where the liquidity is created after the break of structure. Okay, and then we have a different scenario when it comes to the type two, where the liquidity is created before the break of structure. Okay, now on this aspect, if you look at this, you see the liquidity was created over here, which is this high. Okay, this high over here. And then there was a break of structure from this low. Price retraced back, created a relative equal low to match this liquidity model, and then cleared that out to move in the direction immediately. Okay, now this is also engineering liquidity, as you can see, similar to the first model. All right, but at the same time, it tried to create a relative equal high to the previous liquidity. So this is basically engineering more reasons why traders wants to sell from this point, given the information I gave you guys about the support and resistance level and liquidity. So this move was created to engineer liquidity to this point so traders could sell more into this before price cleared that out. Okay, but the liquidity itself was created before the break of structure. Okay, similar to what we had here. And then liquidity was engineered to clear out market structure. All right. So you have cases like this as well where price happened really fast. But this wasn't what I would consider a formal break of structure, but a stop hunt. A stop hunt was made to this low. And then price returned back to fill the imbalance we had within this price action here. Okay, so this was not a formal break of structure. To me, this was not a formal break of structure because this happening, we could easily see this high getting cleared out. Okay, but price returned back to fill this fair value gap, fill up the imbalance, then return back to the price action. As you can see, this was very, very fast. Okay, so the concept of imbalance, which is what we have here as well, concept of imbalance is also a very, very valid tool that could help traders in identifying movement when it comes to price action. Okay, imbalance is also very, very, very vital. So if you want us to do a video on imbalance, we can also break that down. But when it comes to liquidity and identifying liquidity, this is basically how I use these are the models I look out for. Was the liquidity created before the break of structure or was the liquidity created after the break of structure? When you find situations like this where there's liquidity and then you still see liquidity being engineered, then it's a high probability um, area. So you have to now look for the demand or supply zone above or below it. Okay, that's depending on the trend of the market. So you have to understand what you call liquidity and what you call the inducement. All right. So in terms of understanding this, I would call this liquidity in a pending range, which is waiting to be cleared out. And then when this is happening, traders are being induced into the market because this is engineering liquidity to support this, which has already been created. Okay, so liquidity and inducement are basically the same thing, but both happen in different times. That's what we can say. Both of them happen in different times. One is between one, which is the concept of liquidity has inducement within it. Okay, so inducement is basically a term that was later introduced after liquidity because everybody was familiar with liquidity before we started hearing inducement. But the term inducement is explaining basically what happens when price is now generating liquidity. It's basically inducing more traders into the market. Okay, while liquidity can be created and then be a target, they can't already have inducement pending, and then they're still trying to, say price is going to be clearing out this inducement later on. It's liquidity. Do you understand? It's liquidity. It's the same thing, but the inducement is when it's being generated. When you're being induced, this is an inducement. This is a pending liquidity order. So this is liquidity high, and this was inducing traders into this liquidity high before they get cleared out. All right. So I wanted to explain this because we have a lot of breakdown going down within the community. And if you're not in the community, you can easily join us with a link in the description. A lot of guys are sharing their models, their insights to what they think about liquidity and inducement. And this is just a quick video to give a breakdown on how I understand liquidity and how I use them when it comes to terms of smart money concept. Okay. So like and subscribe and leave a comment below if you want us to look into imbalance or stuff like that. And then you can join the community for more insights like this on Forex trading. Thank you and see you on a different episode.